Let's talk about indexed annuities. You hear that term, and what comes to mind? For a lot of people, it's just confusion, right? Is it a fixed thing, meaning it's super safe? Or is it some kind of safer version of a variable annuity? The labels seem to contradict each other, and it's easy to get lost. So we're going to cut through all that noise and figure out what this thing really is. The appeal is so simple, isn't it? Of course, you want the growth potential you see in the stock market, but the idea of losing your hard-earned money if the market takes a nosedive? Yeah, that's a tough pill to swallow. It's that classic dilemma in finance. Index annuities kind of step into that gap and say, hey, I'm the solution. But the real question is, what are you actually buying into? All right, so let's just get right to it. Let's tackle the biggest point of confusion head on. Is this thing a fixed annuity or is it a variable annuity? The official legal classification is really where we start to find some clarity. And, the answer might actually surprise you. And there it is. That's the answer. Legally, technically, an indexed annuity is a type of fixed annuity, period. That's probably the most important thing to get straight. That word indexed doesn't create a whole new category of annuity. It just describes how the interest gets calculated. It is not a variable annuity. It's a fixed one, plain and simple, that just happens to link its interest payments to an index, like the S&P 500. Okay, so you're probably thinking, wait a minute, if it's a fixed annuity, how in the world can it offer returns that are connected to the market? And that's exactly where most people get tripped up. The secret is in this really clever design where your money is linked to an index, but it's not directly invested in it. Let's take a closer look at how that actually works. This right here is the absolute core of the whole promise. Your principal, the money you put in, is never ever directly exposed to stock market losses. What the insurance company does is they take your money and keep it safe in their own conservative investments. Then they use a little bit of the earnings from those investments to buy options on the market's performance. So you get a shot at growth while your original cash stays safe and sound. So how is that growth actually figured out? Well, it's not unlimited. Your potential gains are going to be limited by one of three common methods. First up, you've got a cap, which is basically a ceiling on your earnings. If the cap is, say, 7% and the market index goes up 10%, you get 7%. Simple as that. Next is a spread, which works kind of like a fee. If the index gains 9% and the spread is 2%, you get credited with 7%. And finally, there's a participation rate. If the rate is 80% and the index gains 10%, you get to participate in 80% of that gain, which means you earn 8%. These limits on your growth, they are a huge reason why an indexed annuity is just fundamentally different from a variable annuity. And we're not talking about minor details here. These differences get to the very heart of how much risk you're taking and what your potential reward can be. This is probably the clearest way to see it. With an indexed annuity, your principal is protected, full stop. With a variable annuity, your money is directly invested in sub-accounts that act a lot like mutual funds, and that means your principal is absolutely at risk of loss. This is the single biggest distinction between the two. It's why variable annuities are treated as complex investments that require a prospectus, while indexed annuities are regulated more like straightforward insurance products. So, with all of that under our belts, we get to the most important question of all, right? Is this product actually a good fit for you? And to figure that out, we have to be really honest about the trade-offs that you're making. When you lay it out like this, the trade-off becomes super clear. The pros are pretty compelling. Your principal is always safe, any gains you get are locked in each year so you can't lose them in a downturn, and it all grows tax-deferred. But the cons are just as real. Your upside is limited by those caps and rates we talked about. The ways interest is calculated can be kind of complex. And yeah, you'll get hit with surrender charges if you try to pull your money out too early. So who is the ideal person for something like this? Well, it's typically someone who's getting close to retirement or is already there. They've spent their life building their nest egg, and now the main goal isn't crazy growth anymore. It's preservation. They want a little upside, sure, but they absolutely cannot afford to lose what they've saved. On the flip side, if you're younger, you've got a long time horizon, and you're totally comfortable with market swings because you're chasing those unlimited gains, this product probably isn't for you. And in the end, it really all boils down to this one very personal question. Are you, personally, willing to trade the potential for unlimited growth in exchange for the guarantee of protection? There's no right or wrong answer for everybody, but understanding that this is the core trade-off, that this is the deal you're making, that's the key to deciding if an indexed annuity has any place in your financial future.